Floor is open for questions, comments, and ideas for what to do about it. Please announce yourself, tell us who you are, where you're from, and fire away. Yeah. Floor is open.
Stanley Roth, Boeing, and start you off with an easy question. Could you talk a little bit more about political risk and Treasury's assessment of the impact on prices? The reason I mention this is we had an oil analyst in to brief the company, a rather major factor for aviation, and he said that he thought that at least $40 of the price, this was when oil was $140, was due to concerns over political risk. He talked about Venezuela, he talked about Nigeria, of course talked about the Middle East and the possibility of a strike against Iran. But it struck me as a very high figure. Do you have, the U.S. government, have an assessment on this?
Well, I don't have an assessment in terms of being able to assign a certain percentage of the increase in price to those geopolitical factors, but it's of critical importance. And an interesting anecdote. The Jeddah conference is, you may recall, happened 6 weeks or so ago, where energy producers, consumers, many of the multinational oil companies came together. One of the key themes that many around the table highlighted was this concern over this geopolitical risk. And ironically, on that very day of the conference, there was a production in one of the Nigerian offshore platforms that went down temporarily, which resulted in a very significant increase in price, over $10 just within that day. So clearly the markets are skittish, and I think the skittishness is exacerbated by the fact that the markets are so tight, and you realize that as you project forward, both on the supply and the demand side, that there are expectations of a continuing divergence in terms of the ability of the global supply to meet that demand. And so they play a really critical role, and there's lots that we can do, and I think are doing with many countries to ensure that those resources remain secure and stable, but it's a big factor.
Question in the back.
Eliza Patterson, would you speak a little bit about your thoughts on ethanol and biofuels?
Yeah, thanks. Well, as you know, the president put his biofuels initiative in place last year. I would not attribute a significant amount of the increased use of ethanol to the president's policy. And by that I mean, if you look at the president's policy hasn't even had to be binding in any way, because the prices of oil have gone up so significantly that there's been a substitution effect to ethanol that has happened in spite of the president's policy, not because of it. And we're in a transition period with biofuels. And I think most people who follow this issue and follow it carefully agree that we need to make a transition as quickly as possible away from the use of foodstuff and food products as the source for biofuels and move to cellulosic ethanol. And the question that I think most people are focused on now, I think quite appropriately, is how quickly can we make that transition? Because ultimately, we don't want to see a significant trade-off that needs to be made. I think the estimates that I've seen in some of the public discussion of this in terms of how much of the increase in food prices can be attributed to ethanol vary. But I think our thesis would be that there's a supply and demand fundamentals issue that's very much in line with what I described in the oil price taking place in the food markets. That's not to say that ethanol policies don't influence that, but the primary drivers here in terms of food price increases are fuel prices, are limited supply due to some natural catastrophes in the last year, a drought in Australia and so forth, and then this growing demand, which again, the source of that growing demand is a great thing. It's the fact that the emerging markets are growing and that people are becoming wealthier and wanting to move up the economic scale in terms of their use of energy and their consumption of food. All a good thing in many ways, but that's part of what is explaining the supply and demand gap that we see.
Back up here.
Thank you very much. My name is Joachim von Braun, the International Food Policy Research Institute. I'd like to stick to this topic for a moment. energy prices and food prices. Our estimates of the biofuel effects, especially in Europe and North America, to the contribution to food price increase is about 40% of the total increase. Council of Economic Advisors is about 33%, so the profession doesn't differ too much anymore. However, the role of subsidy and of quotas in the US and in Europe still is very significant. You made this very strong statement, good statement, that countries who have currently subsidies in place and for energy should have plans to get out of them. Do we have a plan for getting out of subsidizing biofuels, especially for corn-based ethanol, because it really hurts poor people?
Well, thank you for that opportunity to make news today. I'm grateful for that. Listen, I think the general thesis that I laid out there is one that I would stick to, which is, as a general rule, subsidies are market distorting. They're market distorting from a demand standpoint. There's lots of history, as you know, on how different subsidies are developed and what, in the case of our own programs here in the United States, what they're developed to offset, and there's a whole complicated set of political decisions that have been made over time. But certainly I would stick to the point I made on broader comments around fuel subsidies, which have distorted demand in many of these markets, and ultimately, because of the growing cost associated with those subsidies, these governments have not been in a position to invest those dollars that they've been paying in subsidies in other more productive ways that could help their populations. And that holds true both in oil-producing countries as well as non-oil producing countries or oil importers. So whether we're talking about India or China or the Middle East, where fuel was heavily subsidized. And you see this playing out in the demand numbers in a very significant way.
Let's go to the back.
I'm Brad Hamlet from Congressman Bob Inglis's office. Given that the United States owns 3% of the world's proven reserves of oil, would you mind sharing your thoughts on Newt Gingrich's recent drill here, drill now, pay less media campaign?
I'm not that familiar with Mr. Gingrich's campaign. So if you want to be more specific, but certainly I could talk about drilling here at home if that's the question.
Yeah, okay, I'll rephrase it. Do you think that drilling here in the United States would significantly affect the world price of oil?
Yeah, thanks. Well, as I tried to lay out in my remarks, I think there's a whole portfolio of actions that need to take place both on the supply side and the demand side. On the supply side, drilling is part of that. It's developing additional production capacity and refining capacity, and that's both at home and abroad. So, in terms of what effect it would have tomorrow by making decisions in that regard, I certainly wouldn't want to speculate. But it's absolutely the case that there are many markets that are closed that need to be opened. That would increase production capacity. That would increase refining capacity. And we need to be able to do that at home. We're a major producer of oil. And I think the case we would make is that you can do that in an environmentally sustainable way that helps address the energy supply challenges we have and also makes our efforts to open markets abroad for further production and further refining more credible. That's not meant to suggest that that is the only thing we need to do. There's all kinds of actions on the demand side, which I won't go through again. And on the supply side, there needs to be an even greater emphasis on alternative energy sources. And so the case I would make here is that we can't afford not to do all those things. And in fact, given the projections on global growth, given how the emerging markets we hope will continue to grow and prosper and demand more energy and consume more, that ultimately puts a greater burden on the global economy to find alternative ways to support that need.
Thank you. Mark Finley with BP. Thank you for the presentation. We can observe the dynamic around the world of a number of producer countries making more on the increase in prices and increasingly becoming less worried about the P times Q side, the quantity side. In fact, we hear a number of countries as they grapple with the distortions in their own countries from these revenue booms saying, well, maybe we don't need to kill ourselves to grow capacity.
Yeah.
And my question is, you mentioned this is specifically a policy objective. What specific leverage does the U.S. government have to convince these countries that now is a good time to invest in growing capacity, whether through their own national companies or through private investment?
Well, I'd say a couple things. I don't have a detailed analysis. This would be a great project for IIE on the economics of this, but I think there's a point, as I talk to some of these oil-producing countries and their key ministers, I think there's a point at which a high oil price becomes very counterproductive to the long-term interest of the oil producer for two reasons. One, at a certain price, you begin to see significant shifts in behavior. And those, just like the demand side is relatively inelastic on oil, at least in the short term, once you begin to see those behavioral shifts, I would argue many of those behavioral shifts will continue. So if people move to public transportation or lower cost automobiles or whatever it is, I'm not sure those demand changes snap back when oil is at $70 a barrel. So you begin to undermine the consumption profile globally. Second thing and we already see this, is that the investment hurdle becomes a heck of a lot lower if you're at $125 a barrel or $150 a barrel, where investment flows into alternative energy source, which ultimately creates an alternative. And so if you're thinking about the net present value of the resources in the ground, I'm not at all sure it's in the oil producer's interest to just have that price be as high as they can, constrain supply, and in the long run, they're going to make more money. So that's one point. Second point, on the investment side, I think the story is very uneven. I think in some places you see enormous investment, and that is encouraging in terms of new production and new refining capacity coming online, new refining capacity in India, new production and refining capacity in Saudi Arabia and in other places. But one of the challenges is that in these nationally owned or countries that aren't open to foreign investment, you don't see that investment in a consistent way, and when the investments are made, they're not optimized in terms of the production. And in many of these existing fields, you see production being below what it might be if we had the leading technology, the best practices in terms of managing that yield. And it's not clear at all, to me at least, that once we lose that opportunity to optimize the yield, that you can go back in time and be able to extract what you would have been able to extract the first time had it been done in the most cost-effective and productive way possible. So ultimately, I think there's a strong case to be made to these oil-producing countries to think about this as an asset which they need to manage very carefully and optimize their long-term return, their net present value in the ways that I described.
Back to the mic in the back.
Hi, I'm Megan Eckstein from Congress Now. I was hoping you could talk about the congressional efforts to crack down on the futures trading market and whether you think that would affect prices at all.
Yeah, thanks for that question. I wouldn't want to make any specific comments on any specific piece of legislation. I would just make several points here. One, as I tried to highlight in my remarks, speculation is very different from manipulation. Short-term investor is very different from manipulation, and manipulation is illegal, and the CFTC is in a very strong position to act and act decisively when the need arises. The second point I would make is that we think the CFTC has the authorities that it needs to monitor and operate within this market effectively. The efforts that it's undertaken to get greater transparency, the report that's underway that'll be released in September is a good example of that. So we think the CFTC has the authorities it needs. And then third, and probably most important, as I tried to lay out in my remarks here, there's no evidence, there's no suggestion that the underlying root cause of what we're seeing in oil prices is this short-term investment. And in fact, these investors play an important role in the markets. So I don't know the specifics of any piece of legislation, but that would be our position on that topic in general.
Dave, let me perhaps, if I could, broaden that question a little bit. Your emphasis in your remarks was on the long term and the fundamentals. But as you know, lots of people have been searching for something to do about it in the short run. I testified on the Hill last week. They had a hearing, banking committee on the House side, on the dollar and energy prices. It turned out to be mainly on energy prices and a search for something to do in the short run. That same day, the House actually got a large majority for a bill that would have forced the administration to sell 70 million barrels out of the SPRO. So that's one idea that's pushed in the short run. Another is to relax some of the environmental regulations. Both of those things were actually done by the administration after Hurricane Katrina, at least for a short period of time, to cope with the supply shortfalls at that time. So, to be provocative, what's wrong with that? What's wrong with taking some short-term actions? Do you think they would be effective, at least to bring the price down in a short run? And given the economic perils that you deal with every day in your job, wouldn't that be a good thing to do?
Yeah, thanks. Well, thanks, Fred. As always, thanks for being provocative, Fred. I was sorry we weren't going to have a provocative exchange. On the SPRO, I mean, if you believe what I've just said, hopefully you're all convinced. You're sitting on the edge of your chair saying supply and demand, I'm a believer. Well, if you believe that, then the SPRO is a temporary fix at best. 750 million barrels in the SPRO. If you think about our demand on a given day, the SPRO can only support that for a temporary time period, and ultimately the effect will be temporary. Second, the SPRO was designed for a very specific purpose, which was to be able to support the U.S. economy in a time of dire need, when geopolitical forces, when unexpected changes in the global energy supply required us to be less dependent on foreign oil. So, doesn't solve the problem, and has a different purpose would be the short answer. But I think it's indicative of I think that suggestion is indicative of something that I'm trying to argue against a bit here, which is I think we need to take the longer view. And I think that whether it's the SPRO or the currency movements or speculation, these are all inherently attractive, because if that really is the main driver and you can fix those which seem more imminently fixable, then you can affect prices in a very significant way in the near term. And just to give you an example, I was in, as you said, I do the G7 and the G8, so I was in the G7 in April 9th, and we had this debate among our G7 colleagues, and they were absolutely concerned about the price of oil. It was a major drag in the U.S. economy. We were all concerned. It was $100 a barrel. They were absolutely convinced that currency was the main driver. They were very insistent that we should highlight the linkage between currency and oil, because that would ultimately be able to we'd be able to show that we sort of got the joke in terms of what the driver was. And fast forward 60 days later was or 90 days later, which was the G8 finance ministers meeting in Japan. The price of oil was $145 a barrel, and the dollar-euro was exactly at the same level. So these things are inherently attractive to zero in on, but ultimately it's going to take a whole series of actions on both the supply side and the demand side, and it's not going to be a short-term solution. And so I think that's where we need to focus our efforts.
Just to maybe push the SPRO point one further notch. When I testified last week, members on both sides of the aisle were very taken by a comment that Chairman Bernanke had made the previous week when he testified to them. He suggested that a change of 1% in supply could lead to a change of 10% in the price. And the members were interested and raised that question. We believe that's right. If you believe that's right, Chairman Bernanke apparently does, then you could add that amount to daily supply by SPRO sales for a fairly significant period of time. Again, a question, do you think that's right? Or would the fact that it is inherently temporary, it's going to run its course after a few months at most, obviate the impact? Or should you go ahead and do it, and in the meanwhile be putting all the longer-term things in place?
Well, if you put aside the fact that the SPRO has a different mission and a different, and there's very, very significant risk about diverting it to a different mission, and just put side by side two options. Option one is that Carcinia and other new production facilities around the world come online, and there's 1 million new barrels of supply a day into the future, or a scenario where through our SPRO or some combination of others, you're able to put 1 million barrels a day of temporary supply. My thesis would be that you're going to have a much more significant impact on price with the permanent supply injection than the temporary one, because while in both cases you affect near-term supply and demand, the futures market will build in the fact that ultimately it's temporary. And so some of the behavior I tried to describe in my remarks among consumers and producers won't be affected in any meaningful way, whereas on the permanent supply solution, you're going to ultimately affect the market. So, could it have some temporary impact? Perhaps, but ultimately the solution lies in more consistent long-term supply and fundamental shifts in demand.
Okay, right here.
Yes, hi, I'm Jim Ostroff with Kiplinger Editors. Long term, you had made the point time and again here about the need for a sustained, concerted, international initiative here to address the longer term issues and the real issues of supply and demand and conservation, development of alternative fuels. Will it take the initiative of the United States to bring that about? Do you feel that's the rightful role of our government, to light that spark, to take the lead?
Yeah, thanks. Well, first, if you just looked over the last several years, I think you're seeing a growing convergence in terms of major producers and major consumers zeroing in on some of the key challenges we face. And while there's differences of degree, so if we had some ministers from some of the oil producers in here, they would put out a greater emphasis on dollar depreciation or speculation or short-term investment than I've put. But I think you'd find very few people who would say that in the longer run there's not a supply and demand mismatch that needs to be addressed. And so I think that there's a growing consensus around that. The United States is the largest energy consumer by a lot. We're the largest oil consumer in the world. We're the largest or number 2 coal producer. We're the number 3 largest oil producer. So in many of these production markets, and certainly on the consumption side, we are absolutely critical to any effort that needs to be orchestrated from an international standpoint. Now, ironically, the demand, the incremental demand is coming largely from the emerging markets. So OECD demand has remained flat while the emerging markets have grown. So there's a parallel, which is the climate change discussion, where you can look at the baseline consumption or the baseline emissions on greenhouse gas emissions or on energy consumption, and you would find a very similar story where the industrialized economies are the bulk of the baseline. But if you look going forward on growth, the energy demand growth and the greenhouse gas emissions growth is largely in the emerging markets. So that brings me to the second point, which is any meaningful solution has to have them as active participants on the table and recognize that whatever we do on energy supply, whatever we do on climate change, has to be done in such a way that doesn't force a zero-sum game with those emerging markets, which requires them to trade off growth with some of these other objectives. That's first of all, it's not politically saleable, and second, it doesn't make sense.
Dave, just to follow up on that one too, but this is much less provocative. There's been talk for several years about inviting China, India, and some of the other major drivers of the increase in energy demand into the IEA. But it hasn't happened. Now, you've worked effectively with China bilaterally in the Strategic Economic Dialogue. You've got a major program of cooperation going, which I think is a great thing. But why has there been such a hang-up of bringing now the major drivers of world consumption into the consumers' organization, the IEA? Why can't that get done?
Yeah, without pointing to any specific country, I agree with the thesis. So I think these international institutions, the IEA being one of them, need to reflect the current energy profile of the world, in this case on the consumption side, or they're simply not going to be affected.
But what's blocking broadening of IEA membership?
It's different by country. Some of it's quietly being discussed, so I won't get into it. But I agree with the thesis.
Okay, good luck on that. Okay, any more questions? Yeah, in the middle.
Vyas Naqshbandi, American University. Could you please comment on the possibility of increasing refining capacity in the U.S.?
The reduction in refining?
Refining capacity, how to increase.
Increasing
Yeah.
refining.
Increase.
Yeah, well, it's an interesting question. I'm not the expert on it. I would just point to two things. One, I've had feedback from when I've made this remark in the past, and we have some in the audience who might be able to give further insight, that there's the statistic where we haven't built new refining capacity in 2 decades or something like that, new refineries. And some of the folks I've talked to in the oil and gas industry say, well, wait a second, that's not true. We've built new refining capacity, but it's been expansion within existing refining facilities as opposed to new greenfield refineries. So it's not completely true that we haven't grown capacity. We have grown capacity. Many would say that it's not enough, certainly globally. And part of the challenge you hear from the Saudis and others is that there's not enough refining capacity for some of the heavy crude that is available, and the refining capacity, while maybe sufficient, if you look just at oil refining, isn't sufficient when you begin to break it up into different categories and different types of oil that will need to be refined. The second thing just would refer to the President's announcement and this licensing process and trying to streamline that is one of the challenges that we've heard from others. But I'm told that new refining capacity is going to come online, I guess, next year in India, which could be over 500,000 barrels a day. And I know Carcinia has refining capacity associated with that. So there are examples of new refining capacity coming on board globally, and I think within our own country that will need to be a priority.
Ted?
Ted Truman from the Peterson Institute. Mr. Secretary, I'd like to take you back to the demand side of supply and demand. Yesterday we had Rick Mishkin here. I'm going to really make two enemies at one time. Rick Mishkin here, and he said monetary policy has nothing to do with the supply of oil and demand for oil. That's all controlled in Saudi Arabia, in the Middle East. We can't use this to get them to produce more. But policy does operate on the demand side, and you said in your remarks, right, that global demand has been. The good news is global demand has been growing. We've had 4 or 5 years, or up until this year, 4 or 5 years of remarkable global growth, right? And the bad news is that's driven up prices, right, including of oil and of food and other agricultural commodities and other commodities more generally. So, question, maybe, we, meaning the G7 or the G7 expanded, right, are the problem. The world economy has been growing too fast, and that has outstripped our capacity to supply it. And if we had grown more slowly over the last 2 or 3 years, that we wouldn't be nearly in this pickle that we are today.
Well, thanks, Ted. I mean, as you know, the global demand side of the equation has been greatly enhanced by the emerging markets, not the G7 or not the G8. So the engine for growth in the global economy has been those markets, and they, of course, have been the engine for growth in the commodity markets and in oil in particular. And certainly there's a question that if you sat with our friends from China and India and others, whether they're growing too fast and how they manage that growth in a way that's balanced from a macroeconomic standpoint, balanced from a social standpoint, but ultimately their goal is to grow in a way that's being able to bring up the hundreds of millions in poverty in many of those countries to some sort of acceptable living standard. So I guess I would say that I would come at it a little bit differently, which is that we've been unable to keep up with the growth in the overall economy and the growth of demand because we haven't made some of the choices a decade ago, some of the choices in the last 5 years even, that would have allowed supply, not just oil supply, but supply more broadly, energy supply, to be more diverse and larger, more significant. And on the demand side, as these countries have grown as they have, they're in a position to revisit a number of their core policies, and one of the ones that we hope they'll revisit is this question of subsidies, because certainly the demand profile is distorted by the fact that they're so heavily subsidized in fuel. And one could very easily imagine a scenario where you could eliminate those subsidies and find ways to support the broader population in ways other than subsidies that wouldn't distort demand as these subsidies have.
Yeah, hi, I'm Mohsen
Hi.
Khan. Hi.
Good to see you.
From the IMF. There's sort of three theories that float around, and you've been talking about them in your talk. You didn't spend too much time on the peak oil theorists and the Matthew Simmons group, which argues that that's a major factor. There are the fundamentalists who believe that it's driven primarily by fundamentals, as you have argued here, and a lot of people argue that. And then there's the people, some in Congress, but some in OPEC, arguing that it's speculative factors. It's a sort of pejorative that people use about speculative factors. I would like to make a distinction and come back to something that Fred said, which is between what is sort of the long run price of oil versus temporary price of oil. If it in fact, the possible attack in a Nigerian field on a pipeline can have such an impact of a $10 increase in the price in a day. When we were all in Jeddah, that's what happened. Then Fred's point does make a lot of sense. If you sort of even announce that Spro is going to be selling 1 million barrels a day or putting 1 million barrels a day into the market, true, you can't make it last. But remember, Hursaniya, in fact, is a long-term project that is just coming on stream. The next big fields are way down the road, so you're not going to see that long-run effect. So my point really is, following up on Fred, I think, personally, it would do a lot of good in terms of if you believe you want to lower prices, to have the sales of a million, or an announcement of a sales, from now on we're going to send 1 million barrels a day into the marketplace. You watch how that price in the world markets.
And just to add to it, and you implied this before, Dave, also, I would think if you were going to do that, you would go to the IEA and try to get some coordination of sales out of stockpiles of other big consuming countries, or even non-IEA members for that matter, so that you could get a multiple of the U.S. impact and do a little more even of what Mohsen was suggesting.
Yeah, I mean, I take your point, and I guess I'm not arguing that a temporary SPRO release couldn't affect price. I think what I'm arguing is that what we're seeing is a fundamentals issue, and that ultimately where we need to focus our efforts on addressing those underlying fundamentals. And whether it's belief that speculation is the answer, or whether it's a temporary incremental capacity put on the market through the SPRO, that in many ways kicks the can down the road. And part of the reason we face the challenges we face are we've already done some can kicking in the past. And so I guess I'm trying to stimulate a focused effort on the things that really matter in the long run in terms of addressing energy supply and demand.
Jessica.
Thanks. Jessica Matthews from the Carnegie Endowment. You've mentioned over and over this word fundamentals. But missing from your talk, except for a glancing reference to CAFE standard, the key fundamental, which is the demand growth curve, you didn't address. Many people have. McKinsey last year came out with an estimate that the U.S. could cut its energy use by 50% with existing technologies without economic cost, indeed, with some gain. Has the Treasury Department addressed this issue? How big, over what period of time, not new sources, but efficiency improvements, how big is that energy resource, and what can we do to get on it, on that new curve?
So just let me repeat the question so I'm sure I understand it. So you're saying what can we do in terms of the efficiency of energy consumption without damaging the economy, or as a...
Yeah. I mean, you also mentioned earlier that growth in global GDP is a pretty good proxy for energy demand growth, which in fact it actually isn't, because energy intensity has been declining rather dramatically over the past years. But all the energy companies, all of them now, say the exact same thing, which is the difference from the 70s. Our biggest, fastest, cheapest energy supply by far is energy efficiency improvements. We have done, except for CAFE, nothing. Except for maybe appliance efficiency standards in the now 20 plus years ago. So the question really is, and it's astonishing that in the midst of this, everybody's mindset is, what's the new supply?
Yeah.
But we know that it can't remotely come online, or none of that will work, nuclear, solar, wind, whatever, altogether, if we're on the same demand curve that we're on now. So I wonder whether Treasury has in fact, or anybody in the administration, looked at what seems to me anyway, the core fundamental.
Well, I think I'd probably take issue with a number of things you said. So where to begin? The first point is I don't have the numbers at my fingertips, but I think if you look at the energy efficiency, energy intensity improvements that the U.S. has made over the course of the last 6 or 7 years, it's been a fairly dramatic improvement. I forget what the exact number that the president had laid out when he first took office, but it was like 16 or 18%. And I think the energy intensity that's actually been achieved has been very significant and surpassed that. Now, that's not been achieved through regulatory action or specific policy action. So the most significant thing has been the most recent CAFE announcement. But as a country, I think our energy intensity has improved fairly dramatically. If I'm wrong on that, please call me on it. Second, I think our energy consumption on a per capita basis, consistent with that, has gone down, and our greenhouse gas emissions in the last year, certainly 2007, which are the numbers I was most familiar with, was flat, and in the previous 5 years we had grown at like 3%, which was better than any other industrial economy, or close to better than any other in terms of greenhouse gas emissions growth. Is there more that needs to be done going forward to affect the demand profile? There probably is. Is the government always going to be the answer in terms of specific regulations or policies? Maybe in some cases, maybe not in others. But I don't recall the track record being quite as negative as you've said. If you're asking me, does the next administration, the next set of congressional leaders need to think about the demand side of this in a very meaningful way, I couldn't agree more.
Maybe we ought to stick with this just for a minute, because it's an important point, hasn't been discussed much. The numbers I have in my head, but others I'm sure can correct, is that compared with where the United States was in the 1970s after the first set of oil shocks, we've reduced our energy intensity by about 50%. We've cut our energy use per unit of output by about 50% over a period of now 30 years. That's the good news. The bad news is that we still use about double as much energy per unit of output as Europe or Japan. So there's been a lot of progress, but there's still a lot more progress that could be made, and if it's correct, Jessica's hypothesis, that that's the lowest hanging fruit in terms of dealing with the fundamentals of the supply-demand balance, then it certainly deserves a lot more attention.
Well, the first thing is the intensity shift has been largely, most of that period was largely a result of from production to services in the economy. So that's it's a different issue, and that's again then a proxy. So the question is, what is actually, but we're on a growth curve, and people are talking about cuts of 50 to 80% cuts in carbon emissions in order to solve climate change. Obviously, these two curves don't remotely connect. But I mean, we can continue this offline, but it's not my hypothesis that there is an immense supply of low-hanging fruit out there. The oil majors all agree on it. The McKinsey study that I cited is a pretty, it's not an environmentalist study, 50% with existing technologies. And, you know, we are starving energy R&D. We've spent, your numbers,
12 billion.
5 weeks of Iraq war on energy R&D in 6.5 years. An RD&D. So we're doing.
Maybe I could give a couple comments on that. I guess you could compare lots of things to Iraq's war. I think that 12 billion that was spent on R&D, clean energy technology, is certainly more that's been spent in any other administration, including the one that preceded it. I think so. So that's a separate point. So you can compare whatever denominator you want to use. That's one thing. On the investment per dollar of investment, where you get the biggest bang for the buck, from a greenhouse gas emission standpoint, I couldn't agree more. It's on efficiency. So the McKinsey chart you're referring to has, I think, is that horizontal axis, and you have, you know, on the left side, clean power infrastructure, and on the right-hand side, in terms of the maximum return on efficiency or on greenhouse gas emissions per dollar of investment, you have all the efficiency efforts. And I think we're in complete agreement that is absolutely where you get the biggest bang for the investment on a per dollar basis. Now, within our country and within in other countries, I think there's a question. Even recognizing that's true, you also have the fact that the economy is enormously dependent on the power sector. So do you invest the dollar in building efficiency here, or do you invest a dollar in clean coal production here, knowing that the clean coal production doesn't have as big an impact on the emission side as the efficiency does, but also recognizing that at least for the foreseeable future, your economy is going to be dependent on coal, and because of that, you want to invest in making that coal as clean and efficient as possible. So those are different trade-offs that need to be made. Those are trade-offs that China and Brazil and other emerging markets are trying to make. Those are questions that we're going to have as well, because you could very quickly convince yourself you need to be focused only on that right side of the chart, but I think that would ignore a big part of the economy, which we want to make as efficient as possible.
John?
John Williamson at Peterson Institute. Fred mentioned a moment ago that the consumption of energy in the United States is about double that of Europe per unit GDP, and I think that's right. The question is whether you think price has something to do with that. The fact that energy has traditionally been extremely cheap in the United States, and now the gas price is beginning to, or was beginning to approach what some of us regard as a civilized level, and then it now, unfortunately, is falling again. I was struck by an experience I had a couple of weeks ago in India when I was in the finance ministry, and I made much the same pitch about the high price of oil being due to China and India, as you have done, and I was quoted some figures. I guess it was the last 3 years, 5 years, 30% of the increase in consumption is China, 30% was in the Middle East and Russia, in other words, countries where the income effect was strongly in favor of consuming more oil, 5% was India, and 11% was the United States. That also suggests that there's a problem in the United States, and the real question is whether price doesn't have something to do with this, whether you shouldn't be thinking of keeping gas prices at roughly the present level, imposing a similar sort of tax on coal, which is consumed in power stations and so on, so as to provide some incentives to make these substitutions that Jessica was talking about.
Well, another opportunity to make news with advocating a tax of some sort. I think the bottom line here is that you do see a shift in consumption patterns as a consequence of the high oil prices, and ultimately we'll see how elastic that is. But my bet, given the polling data that I suggested, given the growing prominence of the environment and energy as sort of a central issue, I think it's sort of moved from the top 5 list to the top 3 list, maybe the top 1 list for many Americans. I think we're in the midst of some pretty significant shifts in demand, and how Americans think about that. I hope that's true, and we'll see if I'm right. But I think we're seeing that now.
Okay, Howard Rosen, I think that'll be the last question, and we'll let the Secretary go after he's been working hard for us.
Secretary Howard Rosen here at the Institute. We seem to see over and over again that bubbles are not bubbles until they burst. You were very clear on your feeling that you don't think that it's speculation going on right now, although you did say over the long run, you didn't think that the speculation would affect the price, leaving open a small crack in the door that maybe in the short run there may be some effect. What would be the risk of doing something about speculation in the short run, just as an insurance policy?
Yeah. Well, thanks for the question. Let me be clear on that. I'm not trying to say speculation or currency movements are not part of what's going on here. The case I'm trying to make is that they're a relatively small part, and the preponderance of what we're seeing in prices is supply and demand and the disconnect between the two. In terms of some of the things that are already underway with the CFTC asking for greater transparency and making sure we understand the market positions, that's very constructive. If actions are taken through regulatory steps or through legislative steps, whatever they are, that ultimately undermine the futures markets, that has a really significant impact, and the ability to operate in effective futures markets, that has a very significant impact on the hedgers. So those that are trying to hedge the volatility that we see in oil prices in the broader markets. So, I've got a friend the other day who I was talking to who runs a $600 million distribution business in northeastern Pennsylvania. It never kind of occurred to me that his life depended on how well he had hedged oil prices. But it does, and the success of his business depends on that. So that's the risk, that we try to take action focused on an issue which isn't the main driver and ultimately undermine the quality of the futures markets. I guess the other risk is that we somehow convince ourselves that we've addressed the root cause of the challenge and don't do some of the longer term things that I've mentioned on the supply and the demand side.